Welcome to Part 9 of our seminar, Understanding Financial Statements. In this video, we introduce the income statement, one of the main financial statements. Included are explanations of revenues, the cost of goods sold, and non-operating items. Please make sure to print the PDF handout found below this video. We will be referring to the PDF handout throughout the seminar.
Okay, we're now going to discuss the handout that shows an income statement on the left side and the fine print seminar notes on the right. It's headed up income statement, retail wholesale. Now the income statement, our second major financial statement, measures profit, net income. It doesn't indicate cash. Right? So a common misconception is that the income statement, which is sometimes called the profit and loss or P&L, tells how much cash we made. Now under accrual accounting, it isn't cash. This is telling us how much we've earned by having done some work or delivered some goods, and how much of expense we had getting those revenues, and how profitable we were. So it's not going to tell us our cash. Right? If we want to know how much cash we made, we're going to go to my favorite statement, the statement of cash flows, right? Which is the next topic. So keep in mind the income statement under the accrual method, which we have to use because of our matching principle. This statement does not show our cash. Now, I'm also going to tell you that as you look down the left side of this handout here, you're going to see net sales minus cost of goods sold equals gross profit, minus operating expenses equals operating income, etc. This is called a multiple step because of all those subtractions that I went through. Right? So there's a number of subtractions before we get to the bottom line net income. And because of those multiple subtractions, we call it multiple step. Okay? So this format is one that companies would probably use internally, and externally they have a choice to use this or a different method. Okay, so let's go over this one, which is a multiple step income statement. And I would encourage small companies and that don't have stockholders and all to use the multiple step. Okay, so let's start at the top. Obviously the name of the company, we said the income statement is sometimes called the P&L or profit and loss. Corporations might call it the statement of operations, statement of earnings. Any one of those headings might be up there. Any of those headings might be in place of the heading income statement. The third line shows the period or that time interval that's covered by the income statement. Earlier I had mentioned only the balance sheet shows a point in time, some instant. The income statement shows a period, such as a year, 6 months, 3 months, 1 week, whatever period we want. Retailers often have their statements in weeks instead of months, 52-week years, 53-week years, or 4-week period, 5-week period. Okay, so we start off with revenues first. So net sales is what we call revenues at a retailer. Revenues for a retailer are going to be called sales. So net sales means net after we subtracted any sales returns or sales allowances, sales discounts. So net means the gross sales minus sales returns and allowances, etc. And then we're to match the cost of the goods that we just sold. What is the cost that pertains to the sales? So we had 1,100,000 of sales here. What did those goods cost us? And so down below I have a little schedule showing how we compute that cost of goods sold. And it's real critical to get that calculation right because of the matching principle. We want to match the costs to the sales. And the other reason it's so critical is because this is the biggest expense on the income statement. The cost of the goods is far greater than the wages we pay to the people selling the goods. So because the goods cost is the dominant expense on a retailer's income statement, we want to get that accurate. So down below, I show how we compute that. One of the ways. Cost of goods sold starts with the cost of the beginning inventory, adds the cost of the goods we purchased, less any returns of the goods we purchased, plus any freight in, and that'll tell us the cost of the goods that are available. So what we have available is the cost held over from last period, plus the current period's cost of purchases. That gives us the cost of goods available. Now we have to take that cost of goods available and figure out how much to show as the cost of goods sold and how much to leave on the balance sheet as the asset. Right? So we got to allocate the $1,155,200 between the balance sheet and the income statement. The income statement needs to have the amount for the goods that got sold, and the balance sheet has to have the amount for the goods that are on hand, still in inventory. And again, we have to decide which cost flow, FIFO, LIFO. And we told you already, you can go to our website to get the detail on that. So that FIFO, LIFO is going to impact two statements, as we can see, income statement and the balance sheet. Okay, going back to the income statement, the third line down says gross profit. So sales minus cost of goods sold is the gross profit. And that's got to be big enough to cover all the selling and other expenses if we expect the bottom line to be a profit. So the gross profit margin, which is sometimes the same as gross profit, but others mean the percentage. So you have to be willing to adjust. Some people mean gross profit and gross margin to be the same. Some people use gross margin to be only the percentage. So in any event, this gross margin is a real key number. And the gross margin percentage is to take the 301,000 and divide it by the 1,106,000. That'll give you the gross margin percentage or gross profit percentage. So the gross profit margins in a percent are real critical. Financial analysts are going to monitor that to make sure that the companies are maintaining their margins. And if a margin slips, that's a signal they can't sell their products at the right prices anymore, and the bottom line is going to deteriorate. And lots of attention paid to gross profit, both dollars and percentage. Okay, after we got the gross profit, we go and subtract the selling, general, and administrative expenses. Now on the next handout, so I'm going to ask you to look at the next handout, we usually see those listed out on a separate schedule because they're far too lengthy to include on the income statement. So they'll just say SG&A, period. And if you want the detail, you'll have to get a schedule of that. Now in the annual reports of big companies, they're not going to give it to you. But at a smaller company, it'll be attached as a separate schedule behind the statement, just like I've done here. Okay, so then we subtract selling, general, and administrative. And I happen to segregate the depreciation. Often it's just combined. I wanted to have it separate because we might use it somewhere else. So in any event, the selling, general, and administrative expenses are referred to as operating expenses. They're in total $186,300. So when we subtract that from our gross profit, we're left with an operating income of $114,982. Now that operating income means from operating our retail store, from our purchases and our sales. There's some other things that might be happening that are outside of the main operation. For example, I might have some extra money in the business that we invest. Well, that's not part of our main operating activities. That's kind of a peripheral activities, the accountants say. So we segregate those near the bottom and then come up to income before income tax expense. So some of the items that are non-operating or other income would be interest that we pay, interest that we receive, or if we dispose of an asset and it's an asset that we're reusing, not part of our merchandise, we'd have to show a gain or loss in there for that asset. Okay, so now we're going to have the income before income tax, and then since this is a corporation, it may have, depending what type of corporation, to show income tax expense. So the income tax expense that you see on an income statement is the expense that matches this income. Right? Our matching principle show all the revenues and the expenses that pertain. So the income tax expense is the amount of expense that pertains to the amounts on this statement. And that number is going to be different than the amount of taxes that we compute on the tax return, because we're going to use different depreciation on the tax return. Right? So I wanted to emphasize this is not necessarily the amount you're going to write a check to the IRS for, or your state government if you have state tax. So this is the amount of expense that is based on those rates, but it's the amount that applies to these dollars. Okay? Okay, so now let's go over to, well, maybe before we move on, let's just reinforce something we repeated earlier. The expenses that are shown on this statement are expenses that were incurred during this period or match with these revenues. Doesn't mean we paid them, right? We may have paid for the inventory 3 months ago. We might pay for some of these expenses next month because we got 30 days to pay. So again, you cannot tell cash just because it's an expense doesn't mean that it is an expenditure. So just because we have an expense doesn't mean we paid the money out. And just because we had a sale didn't mean we got the cash. If we gave people 30 days to pay, we had the sale, but we didn't have the money yet. Got to wait 30 days for that money. So the income statement on the accrual method of accounting shows what we've earned as far as revenues and what expenses we've incurred.